Okay, everyone, thank you. Thank you for coming, and let's get started. So welcome to this edition of our Policy Research Talk Series. These are talks that we organize from the research department here at the World Bank. Gives us a chance to present work that's coming out of the research group, to share the findings with our colleagues, with others in the World Bank group, as well as others outside of the institution. Just to welcome those of you in the room, we have a healthy online audience, so welcome all of you. Today we're going to dive into the findings of a recently released IFC World Bank collaboration report called Financing Firm Growth, the Role of Capital Markets in Low and Middle Income Countries. I meant to bring a copy, but I forgot it in my office. Nobody thought to bring a copy. Okay, sorry. The report draws on data from nearly 80,000 firms worldwide and explores the surge in the capital market financing over 3 decades, from 1990 to 2022, and what it means to investment and job creation in developing economies. We have a slightly different structure to the PRT today, befitting the large number of contributors to this report and the collaborative nature of the report coming from both the World Bank and the IFC together. So to open the session, we're going to have Sergio Schmuckler and Cesar Me, who are the editors of the report. Sergio is the research manager of the macro and growth team here in the research group. Cesar is the manager of the macro and risk department at the IFC. To then walk us through the findings, we have 3 of the contributing authors to the report. From the IFC, we have Pablo Hernando-Kaminsky. He's an economist in the Economics and Market Research Department. And then from the research group, we have Manuel Garcia-Santana, who's a senior economist in the Macro and Growth team, and Alvaro Pedraza, who's a senior economist in the Finance and Private Sector Development team. Following the presentations, we're going to have 2 discussants today. First, we're delighted to have Niraj Verma, as well as Denis Medvedev as discussants. Niraj is online. He's the practice manager of the long-term finance unit in the World Bank, where he works on the facilitation and mobilization of financial markets to support finance real economy sectors, including housing, infrastructure finance, and bond and capital market development. I should note Niraj is stepping in for Duarte Domerland, who's the Director for Strategy and Operations of the Prosperity Vice Presidency, who sadly had to drop out at the very last minute due to a conflict that was beyond her control. But thank you, Niraj, for stepping in. Also, to my left here is Denis Medvedev, who's the Chief Economist for Global Industries at IFC. He was previously Director of Economic Policy Research Department at the IFC and Manager of Firms and Entrepreneurship and Innovation in the unit at the World Bank. Both have extensive experience with lending and analytical work in different regions. So we're going to start with the comments from Sergio and Cesar, then we're going to have the 3 authors, and all of that will take no more than 45 minutes. Then we'll have up to 10 minutes for each of the discussant, and then we'll open the floor up for questions. If you have any questions online, please raise your virtual hand or signal in the chat, and I'll then call on you during the Q&A. A reminder, the session is being recorded, so you're, by participating, you're agreeing to be recorded, I assume. But also, please, if you're not speaking, please do mute your microphones. With that, over to you, Sergio and Cesar.
Well, thank you very much, Dion, for organizing it. Thank you, Claudia and Ryan, for helping with all the organization. Thank you also, Denis, Dorte, and Niraj for providing comments here. And thank you, everybody, for coming. This report that Dion mentioned is a new collaboration that we are doing between the World Bank and IFC. It fits very well with this vision that of one World Bank group and the Unified Knowledge Bank. And it has received support from Maktar, Susan, Paolo, Indermit, and Dion, so from both institutions. These are analytical reports that we are producing in a book that is physically printed. But the book comes also with the portal, the web portal that we are launching at the same time that Alvaro will present at the end. And that's part of also a significant part of the contribution of this work. And also some background papers that are coming up also with more details of the work that is being done. All of that is available online. And this report was initially initiated by Dennis. So thank you very much, Dennis, for all the support and the initial push. I think we were a big kind of I don't know if we foresaw the changes, but good timing in terms of the interest on the private sector, growth, creation of jobs, and private capital mobilization. So this report came out as being very timely with the new interest at the bank. And we will continue to do some follow-up work that we are doing right now on this report. It's about the financing to firms and the volume of financing to firms. But we are also doing some work on the cost of capital. We are probably initiating some work on institutional investors, the connection between banking and capital markets. So it's a series of studies that we are planning to launch. So let me pass the mic to Cesar, but Pablo, Manu, Alvaro, who are main authors of the report, along with also Imtiaz, will present the details of the work. Thank you very much.
Thank you, Sergio. Thank you, Dion. So yeah, so I won't be long here. So I think first, thank you everybody for being here, and also thank clearly the collaboration and also the team. Unfortunately, Imtiaz cannot be here. Maybe probably is online. And that has been, when I joined this project early on, I think for someone new in the institution, the collaboration between the World Bank and IFC has been really, really fantastic. One thing that I was joking about a lot is that Sergio closes his office, there's a coffee, and on Fridays we all go there, sit down, and then exchange ideas. And it was a very good, not only good thing, but also good friendship. So I really like the collaboration. I think we like that to continue. I will stop here. That's it.
All right. Yeah. Okay. Thank you very much, all, for coming today. As they've said before, we'll be presenting our recently published book, Financing Firm Growth: The Role of Capital Markets in Low and Middle-Income Countries. And I'll be joined by two of my other co-authors, Manuel Garcia-Santana and Alvaro Pedraza. So the purpose behind the book was trying to explore what has happened in capital markets over the past 3 decades. And what we do is document the large expansion of capital markets by firms around the world since 1990. Next, which will be presented by Manuel, is we look at the effects of capital market financing on firms. And then finally is what will be presented by Alvaro, is documenting the role of policy reforms in capital markets growth. Now, before going to the main results, I just wanted to quickly touch base on this new database that we construct, which we believe is a very strong contribution. And Alvaro will present a little bit what variables are accessible to the public when he talks about the capital market portal. So our main data comes from 2 databases provided by the London Stock Exchange Group. On the capital financing side, we use Securities Data Company Platinum Database. And then on the firm balance sheet side, we use WorldScope. So both of these databases are historical databases that go back until 1990 up till today. And on the SEC Platinum side, what we have is new capital financing. So we have at the firm issuance level new debt and new equity that is being issued. And provided along with just the numbers or the issuances, we have several variables such as amount issued, which market they're being issued in, the price, and certain other variables. And then on the firm balance sheet from WorldScope, we have this firm balance sheet characteristics, which again are historical data going back to 1990 for publicly listed firms. And so with that database we use in the second part of the book where we're looking at the effect of capital market financing on firms. Now, the main measure of expansion of capital markets, which we use in this book, is what we call cumulative net capital issuance. And this is the proxy that we use of the amount of outstanding capital. And so we construct this variable using new bond and equity issuance. And so it's cumulative in the sense that every year we're adding on new bond and equity issuances, and net in the sense that we subtract bonds that are maturing. And what we find when we compare this variable with other databases, such as from the BIS debt securities, is that this proxies the amount of total capital really well. And so using these two databases, we're able to study about 80,000 firms worldwide. But in particular, what we're looking at in this book is what's happening in low middle income countries. And so we focus on the 20,000 firms that are issuing in capital markets that are located in the 106 low and middle income countries that we study. Now, just a quick point on classification of income group. Since we're interested in studying how countries that were initially classified as low middle income countries and how they evolve over time, what we use is a static definition of income group classification. And the year that we choose is 1990. So in that way, we're able to see firms in countries that were previously classified as low middle income, how they have evolved over time. So our first result and what we wanted to see is at a global level, what is happening? And what we observe is that global capital market financing has grown significantly in the past 3 years. And it has reached approximately $34 trillion by 2022. Now, what we really wanted to look at is, well, is this concentrated in high-income countries, which have historically had access to capital markets, or have firms in low-middle-income countries also been able to access these capital markets? And what we find is that exactly that capital market financing for firms in low-middle-income countries has also grown, reaching approximately $4 trillion in 1990. And this growth can be observed across both income groups when you divide between middle income and low income. So in middle income, we see an increase of 4 times starting from 2000 to 2022. Now, low income capital, although it is relatively small compared to middle income countries and high income countries, it has still grown tremendously and has served an important source of financing for firms in those countries, growing approximately 8 times from 2000 to 2022. Now, one of the things that's always important when you have these aggregated variables, you want to see, well, is this financing going to a few specific countries, or do we see growth or access across the globe? So what I'm showing here is a map where we show firms or countries and the first time that firms in that country were able to access capital markets. So in blue, these are countries which had access starting in the 1990s. Green, countries which firms were first able to access starting in 2000s. And then in yellow, countries where firms were able to first start accessing in the 2010s. And so what we see across the last 20 years is that 45 additional countries have been able to enter capital markets. And these have been all around the globe. So a majority of the low middle income countries have been in Africa, as well as Eastern Europe, Central Asia, and Southeast Asia, I apologize. So we're seeing this increase in capital market financing, but this is occurring all across the globe. This isn't concentrated in just a few countries. Now, next, we wanted to see where exactly this financing is coming from. And so here, what I wanted to show is a division of our cumulative net capital issuance between bonds and equity. And something that pops out immediately is how in lower income countries, we see this predominance of equity financing. So for both low and middle income countries, we see that the majority of this financing is coming from equity markets. Meanwhile, in high income countries, which we use as a benchmark, we see that there's a much more even split, where firms in those countries are equally accessing bonds and equities at the same time. And then next, we also wanted to see whether this financing is coming either from domestic markets or from international markets. So just a quick aside on how we define these. So for bonds, we are able to compare the country of firm residence with the country where they issue bonds. And so there, as you would expect, you simply compare. So for example, an Argentinian firm that issues in Argentina would be a domestic bond, whereas it issues in the United States, it's an international bond. And then for equity, what we do is we compare the country of residence with the primary exchange where a firm is selling their equities. And so again, similar. If it's the same country, domestic. If it's not, international. And I just wanted to point out two things. So this is for low middle income countries. The first is that the majority of their financing is coming from domestic markets. And the second is that this has increased, the share of domestic market capital financing has actually increased across decades. And this is very important since there's a high correlation between market and currency. And so if firms are able to issue in domestic markets, they're more likely to issue in domestic currencies. And so they're not facing volatile exchange rates, particularly with either the dollar or the euro, which are these hard currencies that firms typically have to issue in international markets. So that was the first part where we're looking across countries what's happening. But then what we wanted to examine is within countries. What are the firms that are accessing these capital markets? Is this dominated by a few firms that had access in the 1990s and just keep issuing, or were new firms able to access these markets? And so here what I'm showing is for each year between 2000 and 2022, the amount of new participants that enter capital markets. And so we see that with the expansion of capital market financing, this is associated with a growing number of new issuers. And not only are there new issuers, but you can see that across time, there's this upwards trend in the amount of new issuers that are entering markets. And so in total, for low middle income countries, we see approximately 14,000 new firms entering capital markets between 2000 and 2022. Now, who are these firms? So here what we use is firms that had access to capital markets in the 1990s as a benchmark. We call these our 1990s participants. And the new participants are clearly firms that first access going from 2000 up to 2022. And we find is that these new issuers are younger, smaller, and issue smaller amounts of capital. And this is particularly encouraging since these are typically the firms that have historically not have accessed capital market financing. So this shows some initial evidence that these firms that are typically financial constrained are accessing capital markets. And Manuel will talk a little bit more about that when we get to his part. Now, importantly, not only are new issuers entering markets, they actually account for relatively the majority of new financing. So again, new issuers are entering, but it's not these 1990s participants that are still controlling the majority share of capital financing. So what we actually find for low and middle income countries that approximately 61% of this cumulative net capital issuance is attributed to these new issuers. And this is relative to high-income countries where this is about 42%. So still, in high-income countries, it's still these old or older firms that had access that are controlling the majority amount of capital financing. And then finally, just a quick look across sectors. So here we divide using the first digit of the SIC code, and we find exactly the same thing. We find that across all sectors in our study, we see that new participants are accounting for more and more of the amount that is being of the amount of financing across all sectors. And from that, I'll turn to Manuel.
Okay, so let me quickly recap what Pablo showed us already. So far we saw that capital markets develop dramatically in low and middle income countries, and this development was present across all countries. We also learned that there was a new participation of firms that didn't participate before, and that these firms were pretty different with respect to the firms that used to participate in capital markets in the 90s. Then the question that we try to ask in the book, given this phenomena, is whether this is fundamentally, consequential for economic outcomes. Like this development in capital markets, whether this is going to matter positively for economic outcomes that we are interested on. And we emphasize that the answer to this question is not obvious. Because one possibility is that firms use these new funds they're raising capital markets to repay their previous debt, for example, or to accumulate cash. If that's the case, then you should not expect a big impact on real economic outcomes because firms are simply using these funds to change their financial positions. Another possibility, however, is one in which firms use these new resources for productive purposes, for example, by hiring new workers, by building new plants, or by using more machines in the production process. And if that's the case, if firms really use these funds to increase their production and increase their productive capacity, you should expect positive real economic outcomes. So this is the type of question we're going to try to answer now. In order to do that, we first start by looking at microevidence. We start looking at the firm-level outcomes as a result of issuing in capital markets. So what I'm going to be looking at here is the evolution of some important variables at the firm level. I'm going to be comparing the evolution of those variables for firms that participate in capital markets vis-a-vis firms that did not participate in capital markets. And for example, this is the case for physical capital. One observation that we emphasize is the fact that after issuing capital markets, firms exhibited a significant increase in their capital stock vis-a-vis firms that did not participate. For example, in the case of low-income countries, 1 year after the issuance, we observed that firms exhibited an increase in their physical capital, which was 16% higher than before the issuance in capital markets. And for the case of middle-income countries, this was around 7.6%. So 3 important observations. Observation number 1, as I told you, there's a significant effect on physical capital. The second observation is that this seems to be persistent over time. So it's not only that firms benefit from these issuance at the time of the issuance, but there seems to be some persistent effect afterwards. And that we seem to find that the third observation is that these effects at the firm level seem to be stronger in low and middle income countries versus, in low income countries versus middle income countries. So there seems to be some cross-country variation in the extent of these effects at the firm level. Not only we find that on average firms seem to benefit from participating in capital markets, but we also see some nice patterns across different types of firms. So Pablo emphasized that there was this new set of firms that started participating in capital markets. We were calling them new participants. So these were firms that did not participate in the 90s, but they accounted for an important share of the participation exposed, starting in the 2000s. And we saw these firms were different. For example, they were smaller, they were younger, and as I will show you later, they seem to be more financially constrained before participating. So an important observation is that these new participants, though that accounted for a high share of participation exposed, actually seem to benefit significantly more from issuance in capital markets. So for example, for new participants, we find that this effect on physical capital was around 17%, versus around 6% for firms that used to participate before. So this is telling us that, again, at the firm level, capital markets seem to have benefited firms in their performance, but particularly so firms that didn't participate ex ante. And this seems to be consistent with the idea that, especially for those firms that did not participate before, it was particularly important for their economic outcomes to become part of capital markets. Something that is also important in our findings is that we seem to find some variation in what is the effect coming from issuing equity versus bonds. And systematically at the firm level, we seem to find that the effect of issuing equity seems to be stronger than that of issuing bonds. And this may be driven, for example, by equity providing more flexibility to firms, not having to repay on daily basis or on some particular date basis. Or this may also be consistent with the idea of some literature emphasizing that firms that have better business opportunities seem to select themselves into equity vis-a-vis issuing bonds. So this is also a very important part of the report where, given the nature of the data and the richness of the data, we can separate the type of participation in capital markets by bonds versus equity. As I was mentioning before, one aspect that seemed to be different about new participants is that they seem to be more financially constrained ex ante before participating. And the way in which we try to assess whether firms are financially constrained or not is by using a proxy that has been used in the literature, which is using the MRK, the marginal productivity of capital, trying to understand whether allocating one more unit of capital to a particular firm is going to generate higher value or not. And one of the things we document in the report is that this new participant actually exhibited a much higher ex-ante MRK. So they seem to be particularly constrained before participating in capital markets, which is already telling us that the potential for these firms of becoming present in capital markets was particularly important. Now, if that's the case, if you are convinced about the fact these firms were ex-ante more constrained, exhibited a high MRK, that would imply that once they participate, you should observe this proxy for financial constraints to relax. And that's exactly what we find. What we find is that even though ex-ante they exhibited a higher MRPK, the reduction in MRPK of these firms was much higher than for firms that were ex-ante according to our measure, not constrained. So this is telling you that if there is some notion of financial constraints that could be relaxed by participating in capital markets, this relaxation was particularly stronger for firms that seem to be more constrained ex-ante, which are new participants. So then, given all these pieces of evidence, which are all at the micro level, we try to assess something at the macro level. So at the micro level, we have that firms, after issuing capital markets, they exhibited an increase in physical capital. We find that the firms that particularly increased their physical capital as a result of the issuances were those that were ex-ante more constrained, according to our measures, those that had ex-ante higher MRK. Then the question is whether these facts are going to be consistent with an increase in overall TFP, or overall productivity. And the idea is very simple. We are systematically reallocating capital towards firms that have initially higher marginal productivity, which in principle is going to lead to a better allocation of resources and higher productivity. So that's kind of what we do in practice. What we do in practice, we take all this micro evidence and use some proxies for an increase in aggregate productivity. And these proxies are going to be simply driven by that equation, in which the first term is the share of firm in a particular industry, so how big the firm is in that particular industry. The second component is going to be the MRK of this firm ex ante. So in principle, how financially constrained this firm was before participating in capital markets. And the third term is the predicted change in capital as a result of participating in capital markets. So again, this equation is telling you that if those firms that have a higher predicted change in capital as a result of capital markets are precisely the ones with initially high MRK, you should expect an increase in productivity. So given this equation, which is translating micro into macro, I'm just going to give you some results. So what we find is that capital markets, or the amount of increases in capital that we predict coming from capital markets, matter a lot for aggregate outcomes. In particular, we can explain around 12% of the observed increase in productivity over this period, around 12% of the observed increase in employment, and around 21% of the observed increase in physical capital. So this is telling you that all this micro evidence that we documented is telling you that capital markets seem to have a positive effect in reallocating resources towards firms that were initially with higher potential, and that translated into better economic outcomes at the aggregate level. And this is just the case for middle-income countries, similar numbers as for low-income countries. And I think what Alvaro is going to show you next is, given all these facts that Pablo showed and the effects that we find at the micro and macro level, what were the drivers? What were the policies or potential factors that were behind this increase in capital markets that we just documented?
Okay, so as Manuel was telling you, so this last chapter of the book, we're going to explore the policies that matter the most for capital market development. Basically, we ask what works, who benefits, and how can policymakers better help build capital markets that are deep, that are broad-based, and that are more resilient. So we know that the relationship between economic growth and capital markets, it's a two-way, right? So Manuel was showing how when firms access capital markets, they can, at the firm level, you see increase in productivity, investment, and employment, and that aggregates up at the macro level. But on the other hand, we also know that economic growth drives capital market development in multiple ways. So one is there are expanding business opportunities, and these firms might demand more capital. Households, on the other hand, might have more disposable income, and that would increase savings that would translate, that could be a supply of capital. And then finally, foreign investors might be attracted to those countries. So not surprisingly, I mean, this figure will be, we don't want to shock anyone. During the last 20 years, we see a strong correlation between GDP growth and our measure of capital market development, which is this cumulative net issuance. In fact, GDP growth explains, or accounts for about half of the variation in capital market financing across countries. So with this background in mind, the question is, okay, what are the policies then? So in the book, the way we do is we sort of like to organize the discussion. We think about two sets of policies. One that are related to the growth of investable savings. So think about the supply side. What drives the growth, the supply side of capital. And then the other one are policies that reduce friction and improve or facilitate intermediation. We'll get to those in a moment. So in terms of growing the investable saving, the supply side. So we're going to look at two examples. One is from pension fund reform. So these are, we look within our sample years after the 90s, countries that introduce pension reforms based on mandatory or quasi-mandatory individually funded programs. And these are, we find around 30 countries. And think about the Chilean case that then was replicated in many countries in Latin America in the 90s and then early in the 2000s in Eastern Europe and other places. So naturally, what you would expect is you grow the local investor base. There's more demand for professional management of these resources, which would develop institutional investors. And with standard staggered diff and diff type of strategy, we look at countries that introduce these reforms a few years before and a few years after. And we show a couple of interesting facts in the book. One is that what you see is a large increase in issuances in domestic market, particularly in equity issuances. I mean, they start from a low base, so these are measure of cumulative net issuance is around 0.7% of GDP, and that grows up to 8 years after the introduction of this pension reform for more than 8% of GDP in terms of the cumulative net issuances. Now, interestingly enough, what firms in these countries, they don't seem to be issuing or fundraising in international capital markets, or international bond or equity markets. All of these pension reforms, the development of domestic investor base, tend to generate this issuance at the domestic level. Another reform that you can think of is directly promoting foreign investors, directly bringing foreign investors into the country. And we might think that we can do that by, let's say, liberalization policies, capital account liberalization, policies that include that might ease regulations, that might reduce capital controls, or that directly allow foreign investors to hold domestic securities. So, interestingly, in this part, what we find is that there is we don't see a direct connection between these liberalization policies and the development of. We don't see an additional action in domestic fundraising activity, fundraising by firms in their domestic market. So you see on your left, nothing really much happened. And here for domestic debt, so debt that firms are raising in the local market. You do see a large increase in domestic firms going abroad and fundraising in international debt markets. Now, of course, you might think, well, I mean, we're trying to bring foreign investors, but these investors, if they're institutional investors, they typically tend to prefer markets that are more liquid, for which secondary markets tend to be more active. So even despite relaxing regulation, you still don't see a lot of action that's directly tied to their potential presence. Now the caveat here, not the caveat, but I will comment that Sergio has done great work on this, where there are instances in which liberalizations can lead to an increase in domestic activities, but that has to go through having a domestic investor base that's well developed. And that speaks to the complementarities of foreign and domestic investors, which we probably don't have time to do here. Now, one thing additional that we should note is that if you think about international markets, this size requirement, the cost of issuance is very large. So the corporates that are able to raise financing internationally tend to be, even in our selected sample, which are, we think in publicly listed large corporations, these are even the largest ones within their countries and within their respective industries. So different policies might target different firms. And then the other set of policies I mentioned, we said, okay, on the growing investor base, the other ones are related to improving financial intermediation. So this is how we can reduce frictions that allow money to go from savers to firms. And this basically is by reducing informational asymmetries, transaction costs, or even investor risk. So I'll just have time here to discuss one or two, and we probably need to be closing soon. And then one is related to the development of sovereign bond, the sovereign bond market. And the idea behind it is that when the government issues, you create a yield curve that serves as a benchmark for the pricing of other instruments in the country. And as we can see in our data, those tend to precede corporate bond markets in their respective countries. So it's sort of like a necessary precondition to develop the domestic market. Without this benchmark, firms might be able to raise debt financing, particularly through corporate bonds, but they will have to go and do it in international markets. And we see that in the data, but again, once again, those firms are the largest ones that's sort of like limited for this subsample of firms. Now, one key concern, of course, you would tell me is, well, we worried if to the extent that the government might be borrowing too aggressively, they may be crowding out, and then corporates might not be able to raise financing. But at least as we show in the book and we discuss in detail, this is sort of like a precondition for the market. Just a couple of other policies that we discuss are that again help reduce this friction for financial intermediation are those that are related to investor protection. Think about protections for minority shareholders, improve board standards, and those tend to be related, and we document that in the book, don't tend to be related with more issuances, particularly equity issuances. And then also, we also see a very strong connection between both bond and equity financing and the introduction or the strengthening of disclosure requirements. Of course, transparency and information would sort of like reduce, mitigate investor risk. But there's a trade-off that you don't want to overburden particularly smaller firms that might be too costly for them to comply with all of this. So at the end, what we say is, I mean, of course, policymakers have a great role to play. There's no silver bullet, right? There's no one single policy that is sufficient. And capital market development really requires, sustained, coordinated policy effort that needs to be, targeted to the country context. But of course, you might say we're being super optimistic about capital markets. Are one of many of our client countries might say, well, I've checked all these boxes. I mean, we've done all these reforms, infrastructure in the market, corporate governance, information, transparency. We've developed the institutional investor base. We sort of liberalize and allow for foreign ownership, and still our markets are sort of stagnated, or recently they might not see a lot of volume. But this book, of course, is not the end of the end of the line. We're still doing more analysis, and as you will see in a moment, we're hoping that our data provides also sort of like a baseline for further work. And in fact, as Sergio was mentioning at the beginning, there's ongoing work from the different teams at the IFC and World Bank in different topics that was based from this book. And then finally, I know the team wouldn't forgive me if I don't take a few, at least 1 minute to discuss the capital markets portal. This is something that we're super excited about. There was a lot of work behind it. I don't know if Nicolas Gorno is here, but so basically what this is you can go online and there's an interactive tool to explore trends in capital markets. So it features this interactive graph, world maps, but not only that, the user can customize. So basically reproduce the entire report, everything that Manuel showed you, that Pablo showed you, at different cuts. So you can do, country, look at a particular country that you're interested compared to regional, other countries, and so on. And this tool, hopefully, again, in the same way that we're discussing, but there are other policies that might limit it and that you might be interested in. This is a good place to start to look where a particular country is, where it has been, and then to do additional analysis. So we don't have IMTIAS here, so we have Pablo, Manuel, I'm here, and of course Cesaria and Sergio, but also IMTIAS Ulhag was a big part of the work. And again, thank you very much. We're looking forward to the comment, Dennis, and this is hopefully you'll be able to use or share this tool with interested parties. So thank you.
Well, thanks to the three of you for a very clear presentation. I know there's a lot of material in the book, so you did a great job of really paring it down to something that was digestible in a short period of time. Niraj, is it okay if we start with you as the discussant?
Happy to, Dion. Thanks for the opportunity. No, so thanks everyone for this. I'm stepping in for Dorte, as you know, but I'll try to reflect her comments interpolated with mine. And I'll organize it broadly with some overarching comments to start with, and then 3 points before some thoughts on follow-up research. So let me start by saying big congrats to the authors. It's really a very commendable piece of work. There's a lot of relevant statistics. It makes a compelling case for the role of capital markets in development. And indeed, to the last point that was just made, we're already referencing this in the work that my team does on capital market development. It's great to have some empirics behind the links with productivity and the stories that are behind many of the charts which are there. The pensions chart, for instance, I really love. The sequencing point on sovereign bond markets and corporate bond markets, all of these are issues that we deal with, and it's great to have the statistics behind it as well. It's super timely also because of the broader discussion that is there in the World Bank Group on leveraging private capital as an important avenue and capital markets are an important avenue for the instruments to make that happen. I think on the data, there's a lot of innovative data to emphasize the importance and growth of capital markets for access to financing in low and middle income countries and how this is increasingly happening. It's very encouraging to see that low and middle income countries, the rate of growth has been faster over the time period covered than in advanced economies. So there's reason for hope. I think the other point which also caught my eye was about smaller, newer firms, which of course face larger financing gaps, but also benefit disproportionately from improved access, which of course is a critical point to make. So overall, great job, super relevant for the work that we're doing, super relevant for the corporate context and for leveraging private capital in particular. And big congrats to the authors and the team. So 3 points I wanted to make. I wanted to start with the comment on low-income countries. And I think the report makes a case that capital market development is increasingly providing access to firms in low-income countries. That is true. But maybe a caveat that when we look at today's low-income countries, cumulative net capital issuance as a share of GDP, that still remains very low. So there's a long way to go. That's one point. But also the report, I think, uses the classification from the 1990 period, which includes countries like India and Indonesia in the low-income group, and countries like South Korea, Portugal, and Chile in the middle-income group. And some of that has changed. And a lot of the dynamism and the growth may have come from countries like India, Indonesia, Vietnam, which are now considered middle-income. Our work in the low-income countries does show that there is progress, but it's a tough path. It takes time, and there's no easy way out of that. You have to invest in the fundamentals that were talked about. So that was my first point. On the second point, it's about the different types of financing for different types of firms. So it was really good to see the emphasis on equity versus corporate bonds. As you know, the composition of financing matters for outcomes. Debt and equity financing are both important, but they play distinct roles. And there was a recent report that I'd like to reference, the Unleashing Productivity Through Firm Financing, that Prosperity did, which showed that equity financing was more effective for funding firms, new firms with more innovative activities, as these firms tend to have intangible assets which have limited collateral value. So you would think that equity makes more sense. And so that was a point which I think can be inferred as well from the report. The other point was also that in emerging countries, it's equity and not bond financing that is associated with the rapid expansion of productive capabilities of firms with high potential for R&D and innovation. So that was really good to see. But that said, and I think while it is true that equities have grown more than corporate bonds, but debt from banks remains a dominant source, as you would expect. And one should recognize that there's nothing wrong in that. While we should continue pursuing capital market avenues, but banks remain important as well. So maybe to emphasize that a little bit. And second, also not to lose sight of the criticality of building the foundations of debt markets through government bond markets. And I think that point was made later on in the report because they serve as a base, as a price reference for the yield curve. They enable us to manage liquidity, risks, and returns. So it remains critical to also look at bond markets, including the government bond markets, as a way to establish the foundations for broader capital market functioning. More broadly, the point I'd want to conclude with on this point on instruments is that while capital markets are critical, they are a tool amongst others to provide financing at a cheaper rate and longer tenor. But they are a complement to bank and the banking sector and the broader financial sector, which will probably remain a key source for funding for firms in the countries that we tend to focus on. So just to recognize that point as well as we move ahead. My third point was on preconditions, which I think is referenced in the report, but maybe to emphasize a few others. I think one, just the macroeconomic foundations, the fiscal stability, the sound rule of law, investor protection, and going beyond that as well, and market infrastructure remain extremely critical for capital markets to thrive. So that was a first point. And I think differentiating between how best to engage in countries that have different country conditions. So that adjustment, as we find in the work that we do together with the IFC through the Joint Capital Markets Program, is critical, and you need to adapt to specific country situations. So that was my second point. And thirdly, I think there is a role for targeted reforms for specific market segments on corporate bonds, on securitization, on private equity, or debt funds. So just to emphasize that, and we shouldn't lose sight of that even while we think of capital market development. I think the point on institutional investors was really made well, and fully agree with that. In countries that have a shallow investor base, and many low-income countries fall in that bracket, we tend to help through our work on developing regulations that enable the private sector, pension funds, insurance companies, mutual funds, etc., to develop. In countries which have institutional investors, we work on reforms to diversify their portfolios, mostly from government debt into alternative assets, including infrastructure, which is critical. And third, I think I've made that point earlier as well, but to emphasize the need for capital market regulations and infrastructure, and the work that we do together with the IMF on the FSAP clearly brings out the critical role of financial market infrastructure in this whole thing. So just those points. And lastly, on future areas of research, I think Sergio started with this. I think cost of capital it's a great new research which has been undertaken. We are watching that with great interest and would be very happy to contribute to that. Clearly a super important point for many of our client countries. A second research area that I'd like to mention that we're working with the IFC is on updating the SME financing gap. IFC has always had the lead on this, and we're working together with them on this one for both debt, but also trying to see if we can develop an estimate for equity. There's an FCI publication later on in the calendar year, which will deal with that. And lastly, to point out with DEC, we're working on a global financial sector database, which hopefully will also include several of the key capital market indicators and could build off the portal that you've so well developed and make it available as a public good. So with that, Dion, I'll end here, and thanks again for the opportunity.
Thanks, Niraj, for those really insightful comments. I'm going to suggest that, Dennis, if you come provide your comments, then I'm going to suggest we do a quick round of responses to the discussants, and then we'll use the remainder of the time. We are going to need to really close down today at 1:50. We've been asked to vacate the room, so we're going to have to be a little careful on time, but Dennis, and then a quick round, and then we'll open it up to the floor. Thanks.
Thank you. Thank you very much, Dion and colleagues. Thanks for having me as part of this panel. It's also wonderful to share the floor with Niraj, and I'll make sure that we wrap up on time, so I'm not the reason that we're kicked out of here. I guess I'll just start by saying this is really a pleasure to be here in the sense that it's wonderful to see something from the beginning to end. So I'm kind of thinking back to some of the first conversations that I've had with Sergio and some of the team members about this work, and now being here, I don't want to say it's the completion because I hope there's still a bigger push on the dissemination of this work, and some of the things that have been mentioned in the presentation, like the portal, I think do give this work perhaps a longer shelf life than a lot of the things that we do. So really, but really wonderful to see this come to fruition. Lots of things to love about the report, right? So there's the new data and the new ways of presenting this data, the fantastic tool that was discussed, the exploration of different margins of capital markets. So thinking about the intensive and extensive margin, how much do the same firms issue, what are the new firms issuances across countries, domestic versus foreign angles, etc. So lots of great things about the report. Also the nice connection to the finance and productivity report that Neeraj just mentioned. Of course, it's no surprise given that that report was authored by Tati, who's a frequent co-author of Sergio, and I believe some of Sergio's own work has also informed that particular report. And then, of course, in the kind of the broader spectrum where we operate today, the report is about capital markets, so therefore we expect primarily to look at the effects on financial or physical capital of firms, and that's what we see, and I'll come back to it in a moment, but also we do see quite nice effects on employment. So given the institution's focus on jobs, I think that's a very important feature of the report and something to really congratulate the authors on. So in terms of my remarks, I'll say a few things about how this connects more broadly to what IFC is doing and thinking about, and then make a few observations how I see this on the analytical side, how I see this report fitting into some of the broader questions. So for those of you who have not heard of IFC 2030, probably at least heard of it this morning, and there was referenced I think 3 times in Ajay's email. So for those of you who are wondering what that may be, it's essentially just a view on things that IFC will need to do more and to do more on, to do better, and to scale up. And those things are grouped into 3 big buckets. The first is mobilization, and specifically what that means is, if you will, for every dollar that IFC invests, how many additional dollars from other investors it can crowd in, right? And obviously, if you think about it, capital markets play a huge role in the ability to attract other investors to whatever investment IFC makes, whether it's completely private, whether it's the public markets. There's lots of discussions about things like originate to distribute, which again would require a capital markets. But certainly, if we're going to be successful in terms of increasing mobilization on the IFC side, having more vibrant, more developed capital markets, understanding how these markets develop is going to be a very, very critical part of that. So I think from that perspective, this report is going to be super useful for people, not just to kind of read about all the wonderful things, but really think about what we need to do to make this 2030 vision a reality. The second pillar of IFC 2030 is equity, and having a much greater ambition to increase our equity investments. Again, obviously, a big part of the presentation talked about how equity can help firms grow, and again, how do we further develop these markets? So again, very, very clear links there. And then the third pillar on the 2030 side is MSMEs, and particularly the employment and MSMEs support. And again, of course, the firms that were here in the sample probably would not be captured in the standard definition of MSMEs, but generally speaking, we want to think about younger firms, we want to think about smaller firms, and the fact that the report authors show that these firms have played a big role in terms of entering in the capital markets, growing through capital markets, again, I think makes this work extremely useful for this IFC Vision 2030. So now moving more into the broader knowledge agenda, and here I have three broad points. One is thinking more about the theory behind the work. So I think this is a largely empirical report. It has documented a lot of new facts. It has hinted at some really nice relationships. What I want to think about now, having read this report, is how do we sort of put this together in terms of a theoretical framework, right? And starting perhaps with the title of the report, are we really thinking about firm growth? And I think in a broad sense, yes, although I would say in a particularly narrow sense, we're perhaps more thinking about the size distribution of firms that emerges from a series of events rather than like precisely modeling the distribution of growth rates as you would have in some sort of a Lutmer type framework, right? So what I think we have here is some variation, at least for me, of the Evans-Jovanovic story about the credit constrained firms and how alleviating these credit constraints allows entrepreneurs or firms to achieve larger scale. And this is where I found the differentiation between the new participants and the 1990s participants, or the incumbents, if you will, particularly interesting. But then again, going back a bit to thinking about growth really precisely, what is the underlying framework here? So you have, what you see in the report is a very strong effect of the first issuance, sort of diminishing effects of subsequent issuances. So how do we think about this? Is it the fact that this, the initial constraint is really binding, subsequent constraints become less binding? Is it just the firm jumps from one size before the first issuance to another size and it more or less stays there? Do we think about growth in stages, but each stage perhaps is less of a jump than the previous one because perhaps the most important idea of the firm has already been used up in that very first stage? Or is it the fact that that first issuance essentially puts a firm on a somewhat different growth trajectory, right? And it's what we see here is the jump, but the jump also comes with a change in the slope. I think all of these things are kind of worth reflecting on, and again, would need some sort of a conceptual theoretical framework to help us put these results in a broader context. On the empirics of, the first thing, of course, is we see larger effects on capital rather than employment, for example, which again makes sense given that this is the constraint that firms are alleviating. They're accessing capital markets. Of course, there are data limitations, but one also wants to think about other types of effects. Do we see more innovation? Do we see more exports? So I think as perhaps more data become available, or we're able to do this for fewer countries, thinking about the other types of effects becomes really important. Not just to document them for the sake of documenting, but then really to think about perhaps some quality of growth, right? So is it really the more innovative firms that are able to leverage capital markets to their full extent? Now, again, empirically, the story of the report is around somehow capital markets reducing misallocation, which I think makes sense. Now, what are the sources of this misallocation? Is it the same sort of, we're thinking about the size-based distortions. Again, is it sort of that the younger entrepreneurs are more credit constrained? And then, is it the fact which has been hinted at some of the, in some of the other work, and I believe we've even discussed this earlier in the report, that capital markets are intrinsically more fair in a way that they're a little bit more, blind, more democratic. A lot of the relationships, for example, that drive bank lending and the biases that are implicit in bank lending that we know have been documented in a number of papers, is it the fact that capital markets, just because of their nature, are able to better allocate resources according to true characteristics rather than enforcing these implicit biases. So that could be, for example, why we observe in the report the stronger relationship from equity versus debt, because again, maybe somehow equity markets are even more blind to these sorts of biases, more democratic than bonds. But then, I would also want to think about, well, is it the case that the highest potential firms are likely to issue more equity versus debt, right? And the standard frameworks that we have actually suggest that the more likely you think you are to be successful, the more likely you want to issue debt versus equity, because you want to keep the payoffs of this future growth more for yourself. So I think in disentangling a little bit some of the sources there about why, for example, why we observe equity as being a better or correlated with better performance later on, what is driving it? Is it that, as we always wonder about private equity and VC, it's more than funding? Is it more because there's advice and knowledge and networks and all these other things that come with it, or perhaps not? So I think that's a set of questions. Lastly, on the policy front, which is all about how do we grow and expand capital markets. There are a lot of things already in the report, maybe just pushing a little bit further on some of them. the overall relationship between government and capital markets. So you show that governments issuing helps grow overall the size of the market, but there's also a lot of crowding out that happens in these sorts of markets, right? And we kind of know the standard story about, you know, governments essentially making making the banking sector, for example, somewhat captive, right? And by creating this relationship where the government leans on the banking sector to buy its securities, and the banking sector finds, you know, using their resources to buy government paper, more safe, more profitable investment than lending to companies. Everything else, obviously, that, you know, that creates a types of vicious circles. So how does this relationship become unbundled? The point about the smaller and the newer firms accessing capital markets, one of the wonderful things that come from that. You know, do we have a view on the importance of sort of secondary exchanges, the SME exchanges, all of these things? You know, and anecdotally, I think we've seen a lot of these initiatives be less than successful. So, but I think a policymaker reading this report would very much start wondering, you know, is that something I should be doing? Should I be trying to get smaller companies to issue? And if I can't get them to list on a larger market, do I want to start creating the smaller markets? So I think that's something worth thinking about further. And lastly, you know, again, something that I recall we've discussed many times is the role of investors. And so here, again, going beyond perhaps pension reforms and thinking about who is going to be investing in these markets, what are going to be whether it's going to be foreign investors, domestic investors, what kinds, and how do they put money in these markets given this, what we have seen in the last 10, 15 years in terms of the secular appreciation of the dollar, the capital volatility, the fact that, you know, in many cases one can make higher dollar-denominated returns in advanced markets than a lot of the developing markets. And what does that mean for, again, crowding in investors into these markets? I'll stop here. I'll just, again, thank the team for a wonderful presentation and for having me here.
Thanks, Dennis. Okay. Just a reminder, if you're online and you would like to ask a question, please either signal in the chat or raise your virtual hand. I see one question actually overlaps exactly with one of Dennis's points, so we can come to that. Should we have a quick round of responses if you have some reactions to the points that were made? Let me just recap very slightly just to fix it. Sort of Niraj's point to low-income countries, equity versus bonds, and the preconditions and the future research was sort of some of his big themes. Dennis, linked to IFC 2030, theoretical underpinnings on the empirics, sort of the misallocations and what are the sources of misallocation, and then a number of points on the policy front. So I don't know which order you want to go in, but just take a shot.
Okay, I'm going to start by responding to, Dennis, your point about the theory, which is, I think, is crucial, and we thought a lot about it. So let me reinterpret our findings in terms of some simple theory. So actually, the canonical model of firm dynamics with financial constraint, I think it does a pretty good job in somehow rationalizing all the facts that we find. So if you think about that canonical model, you are going to have that younger firms are going to be smaller on average, and they're going to be more financially constrained because they didn't have time to accumulate enough amount of assets so that they can use as collateral. So in that respect, old firms and younger firms are going to be more financially constrained, which means that if I were to give 1 unit of capital to these firms, they would increase their size more. And that's kind of consistent with the first degree of heterogeneity you were emphasizing, old participants versus new participants. So we expect all participants to be more mature, to have accumulated more assets, to be closer to their optimal size, which means that the marginal effect of 1 more unit of financing wouldn't translate too much into an increase in size. And actually what we find is that they seem to be using this extra financing for unproductive purposes. So in that sense, that's consistent with the theory. The second degree of heterogeneity you were emphasizing, which I think is critical, and we thought a lot about it, is the first versus subsequent issuances. And the idea here is just focus on these new firms we were emphasizing before, like younger firms. What you should expect is that younger firms, as a result of the first issuance, they are much closer to their optimal size. They are less financially constrained. That's what we find. MRPK goes down. So in principle, because they are closer to their optimal size, we should expect naturally that the effect of another source of financing would actually translate into a lower effect in firm size because precisely they are closer to their optimal size already. this is what the canonical model would predict, which I think kind of makes sense of all what we're finding. Now, it is also true that firms, the canonical model is imperfect in the sense that it doesn't allow for firms going in production stages where they innovate and they discover a new technology and then things change. So, and that may be useful to think more about these effects on equity. For example, thinking of equities is more important for firms that have more innovative activity. That's something the canonical model cannot reflect, and we haven't thought a lot about it. But I think as a first pass for the main facts that we document and these two sources of heterogeneity that I think you emphasize very rightly, I think kind of the simple theory can do a good job in rationalizing what we find. But we definitely have to think more about it.
Yeah. If you're in the room and you have a question, please go up to the mic, and then we'll take a couple of questions after this round of responses. Thanks.
Yeah, no, so briefly, thanks, Dennis. Thanks, Niraj, also for stepping up at last minute. I mean, those were great comments. I'll just mention so you did mention the preconditions, of course, with something underpinning all of any development of capital markets is you need fiscal monetary stability, right? So I think that's something that we all agree. And I think you bring a great point in terms of we need to sort of like evaluate targeted reforms that, and what those effects would be. I think maybe Pablo could mention this, but I would say if I want to take the crack at our static definition, maybe you were going to say so. Yeah, no, but I mean, at the end, we need to take a stand into what defines, being low, middle. Again, you want to think about the dynamic definition, or you want to think, okay, let's think about a bucket of countries and how they develop over time. I don't know if you had something else about that, but something that we really just had to take a stand at that. And then it's just quickly. I mean, you're right. I mean, we do have something about SME exchanges in there, but I think there's something. I mean, there's sort of like a mixed views about these markets, and sometimes cautiously optimistic, but it's very mixed. Even in the case of Novo Mercado in Brazil, which is very different how firms were sort of like voluntarily selected to improve corporate governance. Even there was some like initial great success in the 2000s, and then sort of like stagnated, and then there was an issue of how about voluntary corporate governance versus the enforced. So something to keep in mind, and definitely great points. I'll stop there.
Yeah, I'll take building off what Alvaro said on the income groups. There was one that was purely mechanical, which is if you start changing the income group, then you don't really know if changes in the amounts are due to changes in how much they're issuing or whether there's a change in countries shifting from one income group to another. Now, the reason that we chose 1990 is for the exact same reason that you were saying. I mean, you had these countries which were initially low middle income countries and that were eventually able to graduate and no longer be these types of countries. So that's where we wanted to concentrate at. One of the things that was also mentioned was on bank financing. What we do have in SDC Platinum is syndicated loans. So these are loans to firms from several banks. What we don't have is the bilateral loans, which are one bank, one firm, and we completely understand. I mean, this is a large part of financing for, the majority of firms across the globe. One of the things that we were able to do in Alvaro's part in the first chapter was looking at, the size of bank financing aggregated, at a certain level with capital financing. But for the rest of the project, what we needed is at the firm level. And this we only had for bonds and equities. And then one other thing on the crowding out that I think Dennis mentioned, there has been quite a few papers that have shown, during times of stress, when banks are holding larger amounts of sovereign bonds, there is this switching over from the loan market to the bond market. So in that way, the capital markets are able to complement the banking sector.
So if I can just comment on one issue that was mentioned by the two discussants, I think is very important, is the role of SMEs. And it is true that throughout the report we use size as part of our narrative because there is a lot of variation in firm size across the firms we look at. But it's also true at the same time that these firms are large. as compared to the average firm in low and middle income countries. So if I were to have to touch on one aspect of the report maybe a bit unsatisfying, is that at the end of the day, we are not looking at very small firms, firms that may actually need financing more than larger firms. And I think this is precisely where more work has to be done as well, which is, okay, taking these results as a very good starting point, saying even for firms that seem to be relatively mature relative to other firms in their economy, we seem to find positive effects of financing. So in principle, one could expect this as being a lower bound in what would be the effect of actually allowing more financing for firms that are relatively smaller. But I just wanted to emphasize that indeed, this is something of the book we have to be aware of, which is we're already looking at firms that are relatively bigger as compared to others.
Great, thanks. Let's take a couple of questions in the room, and then we'll give the authors a chance to respond. Thanks.
Thanks very much. This is quite a report. My name is Tatiana Nenova. I'm a principal economist in global industries, IFC, working with Dennis. My question was on regional exchanges, whether you took a look at that, because now, especially with Europe thinking of kind of uniting a little more and tightening the regulation around capital markets, if you have in your data set, which you would, some of the regional exchanges, would that make sense to take a look? I also wanted to say a very quick comment. World scope coverage. It does cover 99% of market cap, obviously, but there's quite a few companies that are not covered. And I think, if I remember correctly, those were kind of the poorer the country, the less the coverage. So if you do a robustness check, and maybe you already do for that, it would strengthen all of your arguments about lower income countries having even stronger results. Because if you were able to cover everything, if you were just to compare and say, well, my coverage is much lower in those countries, you'll strengthen your arguments for middle versus low income. Thank you.
Thanks. There's a question in the back, and then we'll come to you. And if you could keep it short, just because we're running out of time. Thanks.
Thank you. It was a great presentation. It allows people outside the field to understand what you found. My first question is about how do we think about benchmarks? Since your analysis is descriptive analysis of how things have changed over time, do we think about this as good enough changes? Should there have been much higher changes, perhaps on the margin of international capital markets, for resources to flow from very fabulously wealthy countries to dejectedly low income countries? My second is a comment/question on the issuance of sovereign bonds. So African countries generally have really low ratings for sovereign bonds, which are not creditworthy. So your policy discussion seems to sort of miss perhaps what are the big challenges. Why are sovereign bonds in African countries, which are really capital poor, so very low? And I just want to highlight the comment of your first discussant that perhaps much deeper institutional reforms of political stability, fiscal capacity, and law and order institutions might be really first order importance. Thank you.
Okay, very quickly. Mine is about how we can extract from your analysis some lessons from our operational activity. So when I was in the region, it's clear, like, for example, we're to low-income countries, we can go and help on early stage financing, or the big firms have access to capital market or banking. But in the middle, when these firms need to grow along, this is where there is more difficult. Of course, equity, as you have said, is some solution. And when we go for a country like, for example, in Turkey, where we work with the IFC through the Green Equity Fund operation, then we have solution. But how do we do for low-income countries where you don't have these conditions in moving from early stage financing to grow in the ladder until you get to, well, more capital markets or banking sector? Do you have, from your analysis, any suggestion for the operational activity? I'm meaning, for example, countries like in Western Balkans, that are small countries, what type of solutions can we offer?
Yeah, so just to quickly touch on a couple parts. So we do a regional analysis. One of the things that we wanted to see, as I showed throughout the presentation, we start at an aggregate level and then start disaggregating, making sure that this is spread out. And so, yes, we do a regional analysis. You can see those in the book just to give you a quick summary, is that we do see growth across all regions. Clearly, within low middle income countries, there are some regions that have developed them more, particularly Southeast Asia. You know, after the crisis in the 1990s, they put quite a bit of effort in developing their domestic bond markets. And the same thing in Latin America, though they issue more international markets. You still do see growth. So in terms of growth rates, pretty high in Africa and South Asia, those type of things. So, and I think this is related actually to your comment, what is good enough? That's kind of hard to say. So here we're just documenting that there is growth across across all regions. Now, the way we benchmarked our report is that we wanted to use first 1990s to compare, you know, what happens later on. Across countries, we used high-income countries to compare what low-middle-income countries were doing, and then within country, we compared new participants with 1990s participants. Now, as I mentioned, is it good enough? We don't see a complete catch-up, and so yes, there's still countries that, as I think one of the commentators said, that not all countries have crossed that threshold to increase to be, you know, high-income countries or upper middle-income countries. So there's still quite a few that remain low middle-income countries that haven't achieved that and aren't issuing that more. But the important thing is that we do see growth. But we, like I said, we didn't want to put a hard stand on is it good enough, because as you can see, I mean, the first graph we have by 2022, 34 trillion. Low middle income countries were only 4 trillion. So there's still quite a bit of catching up to do. High income countries still get the majority of capital market financing, but we do observe growth.
I'll just briefly mention, yeah, I mean, Stuti. Oh, Stuti, you're there. I mean, yeah, of course, without macro fiscal stability, any of this, really, I mean, this is second order to baseline. I mean, we agree with Niraj, I mean, that's a great point. And the benchmarking is relative to high income, whether that's the benchmark, of course it's not. I mean, it's not a normative type of benchmark, it's a benchmark. I will say in terms of, because we're running out of time, in terms of, you know, what to do besides the things that we show here. So, I mean, we know that there are like high issuing costs for many firms. So legal underwriting, compliance. I mean, many firms. The question is what's in the pipeline of firms that are growing, that are able to graduate and get there to capital markets, right? And you have to have that you know, the pipeline of firms that are coming there. And the other question is, I mean, issuing capital markets is expensive. I mean, the compliance, the legal requirements, managing investor relations, all of that is quite costly. So there has to be a push also from a policy perspective into how do we get those firms on those costs, you know, so that they can access. But and it's a mixture of on the demand side, the firms have to be there, the pipeline have to be there, and then I mean, we can think about the cost case, but there's also other frictions that we don't have time to discuss, but we're also looking into.
Now, I was going to mention something on World Cup coverage, point taken. So we didn't think about it practically. We just, so this is my quick reaction. My quick reaction is if coverage tends to be worse in the lower the income country is, and coverage somehow correlates with the size of the firm. So what we seem to find is that in lower income countries, we seem to find stronger effects. And this seems to be despite the fact that maybe the smaller firms are not covered. And we find that smaller firms are the ones with the highest effects. So in principle, if there is an issue with coverage in the way you are mentioning, we should have like a lower bound in the effects in lower income countries. So in that respect would be a conservative finding. So just I wanted to, as a quick reaction to your comment.
Well, thank you, Pablo, Alvaro, Manuel, and Imtiazo. I see is actually online, so thank you for all the hard work that went into this. Thanks to Cesar and Sergio for sort of steering the ship and landing this report, which I think we've seen so far has been really well received. Thank you for coming here. This has been great, and then thank you to Dennis and then Pablo for the great IFC World Bank collaboration. That I think this is emblematic of what, as per Dennis's previous comment, we're about to see a lot more of. I'm really pleased to be here. I was glad to hear mention of future research ideas. cost of capital report is currently underway. We have a research program on financing in small and medium enterprises. So there's a lot of activity happening around this topic, and we look forward to seeing you all the next time we gather around this topic. So thanks again.